Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
That means we have a mutual fund expert who's joining in to answer the many questions that have been sent in by our viewers. Manoj Nagpal, MD and CEO of Outlook Asia Capital, is our guest this afternoon. Manoj, hi, good afternoon. Let's get straight away to our first query. It comes in from Gaurav Kumar, who's on the line with us actually from Bihar. Hi, Gaurav, how can we help you?
Hi, ma'am. Thank you for making me online.
Sure, go ahead. What's your question?
I've just started SIP in the month of Jan this year in two of the funds. That is, one is, it must be coming.
The Aditya Birla Sun Life Frontline Equity, is it?
Yes, it is Sun Life Frontline Equity, and another one is ICICI Value Discovery Fund.
Right.
1,000 rupees each since January 2018.
Okay.
I have lined up another fund, 26th of August this month. That is SBI Small Cap Fund, 2,000 rupees investment. And another one which I lined up is Merai Asset Emerging, this fund which I have added. So I just and 25,000 rupees as a lump sum in Bharat 22 ETF.
That is already done?
Yeah, already done last year only. So my target is, it's in 1 year I want to create a corpus of 1 crore because...
I'm sorry, did you say 1 year?
Pardon?
What is your time horizon for accumulating that 1 crore?
16 years.
Okay.
Yeah. So it is 16 years. In 16 years, I want to create that much corpus. So I just need an advice, whatever I've chosen and what I should do.
Okay, so I've also gone through your query. As I understand, you have two important goals. One, of course, you mentioned, which is your daughter's education, for which you'll need money in 16 years. And then, of course, there is your retirement, right? So your entire portfolio needs to be geared towards meeting these two specific goals. Manoj, he's 38. He has given us details as well of his salary. But does this goal of 1 crore in 16 years seem achievable to you? How can he rejig his portfolio to try and meet these goals?
Yeah, so, the good starting point out here is that he's looking at a 16-year. He's very clear about his goals. So the starting point is very good. And he's trying to achieve his goals by, doing a SIP of 6,000 rupees per month across various different funds and, a lump sum corpus of around 25,000. Now, if you were to put all together and try to do the maths around it, he needs to have a compounded annualized return of 22% plus over 16 years to reach his goal. Now, that's a very, very tough ask. In the past, small cap funds and mid cap funds have given returns of around 22% in the last 15, 20 years. But we strongly believe those were different times. Interest rates were high, inflation was high. We have now moved to an inflation band of 4 to 6%, and we feel that that's where India is going to be for quite some time. And given all that put together, it's to expect 22% returns is not there. One starting point of advice we always give people is that one should try to save around 20 to 30% of their net take-home salary if one is salaried, or if one is working on his own, then 20 to 30% of the net post-tax income that one generates. That's a very, very good thumb rule if you want to meet your goals in the future, and that is very strongly recommended for Gaurav also, that he needs to increase in amount and save at least 20 to 30% of his post-tax income at this point of time. And if he does that, then he is on track to meet his goals. Other thing I would like to advise him is that, since the horizon is long-term, he should run a portfolio with only 2 to 3 funds, not really go across, and his goals are non-negotiable. When I say non-negotiable, for example, when a child's education, you can't defer that goal, assuming you have not reached that corpus. So in this case, his child's education is going to happen on that date. He can't, for example, if you're planning a vacation, you can defer it. You're buying a house, you can defer it by a couple of years if you have not got the corpus. But these are some goals which are non-negotiable, and hence he cannot have a very high, risk portfolio, especially the later part of the thing. So he can run a portfolio which is higher risk in the first 10 to 12 years. Then he has to, shift that portfolio. I would try to tell him that, just look at 3 funds: SBI Magnum Multicap, Aditya Birla Sun Life Equity, Motilal Multicap 35. These 3 funds, if you equally weight and increase your SIP amount either right now or on a stepped up basis every year, you should be able to achieve your goals. That's the best way to do it.
Okay, Gaurav, you have any more questions?
Yeah, just wanted whatever existing portfolio, is it okay, or apart from that I have to add on these what
No, so
Nagpal has suggested?
Yeah, we are saying that you need to rejig your entire portfolio and run a very focused portfolio of these 3 funds only. So you will have to shift those into there. As I said, we don't want to build in too much risk. You are trying to build in risk by putting in SBI small cap, which is, maybe good at now, but it will not, the higher volatility at this point of time would not benefit your portfolio is what we think.
Okay, Gaurav, I hope that answers your query. So basically, need to lower the risk profile of your current portfolio. And like Manoj said, do not forget that a higher risk portfolio in the first 10 to 12 years is okay. But as you near your goals, you need to make it a little more safe, perhaps by moving to debt. But maybe you can touch base with us again at that time, and we'll be able help you a little bit more. But for now, that's the reply for Gaurav. Up next, we have NSS Prasad Rao, who's on the line with us from Hyderabad. Hi, Mr. Rao. How can we help you, sir?
Hello. Good afternoon.
Good afternoon, sir.
Yeah, my question was regarding this hybrid equity funds. As I said, I invested about a total of 50 lakhs on mutual funds, of which 30 is on the hybrid equity funds, and 10 lakhs each on SBI, then Reliance, and then the other one is, what is the other one?
Okay.
I was just, my question is about, what is the tax treatment for long-term capital gains? What is the tax treatment as far as the hybrid equity funds are concerned? Because I'm a retired employee. I'm retired, so I don't want to take much of a risk. So I was just trying to see what kind of tax treatment will be taken for this long-term capital gains for these hybrid equity funds, these 3.
Okay. I think, Manoj, this will fall under the equity bracket?
Yeah, sure. So, the funds which have more than 65% exposure to, domestic equities, they fall under the bracket of they are called as equity-oriented funds. Though what you're saying is right, you have invested in balanced funds. For the taxation treatment, they will be treated as an equity-oriented fund. So, the equity-oriented funds were tax-free, where the long-term capital gains were tax-free earlier, but from this budget on 31st January 2018, from the date of 31st January 2018, the tax treatment has changed. Now, long-term capital gains from equity-oriented funds, like these funds that you hold, now will be taxed at 10%. So, your long-term capital gains tax implication is 10%. However, there is a grandfathering clause that has been added in this budget, that is, your cost of acquisition will be taken as the higher of either your actual cost of acquisition or the value that was on 31st January 2018. In effect, you only pay taxes on the gains above the 31st January 2018 levels. So there will be long-term capital gains taxed at 10% and only for gains made after 31st January 2018. So those are the pointers you should remember. One of the other points you should, we remember is that earlier equity taxation was tax-free and there was a big disparity that was there. Nowadays, you need to remember is that, for debt funds also the taxation is the long-term capital gains is, beyond 3 years, but they are taxed at 20% with indexation. In equity funds, there is no indexation allowed. It's a flat 10%. So effectively what is happening is that whether it's a debt fund or equity fund, the long-term capital gain effective rate of tax is almost the same, around 10% that is there. I hope you understand what I'm trying to say. The tax treatment, a lot of people earlier used to go into equity-oriented funds because of the better taxation. Now that taxation gap is not there. So you may relook at your portfolio if you want to, if you're just invested into balanced fund just for that sake.
Okay, Mr. Rao, I hope that answers your query, sir.
Yes. Okay. Thanks a lot.
Thank you. Have a good day. All right, up next, we're getting a live query that is coming on Twitter. Adil has written to us. He says he had invested in the DSP small cap fund and he wants to know whether he should continue the SIP there or not and what should he replace it with. Correct me if I'm wrong, but this is where they had stopped taking in money, right? So we had spoken to Vineet Sambre actually just this morning, and he has confirmed to us that they will reopen the small and mid cap fund for investors now that valuations seem to have corrected a little bit. it. Therefore, in that light, is that a fund that you would advise?
Yeah, so DSP Microcap Fund, has been a stellar performer in the past. However, in the last 1 year, after it started taking inflows, now that's the irony of the entire situation. They didn't want higher inflows because they thought they will not be able to keep pace with returns. And as the inflows stopped, their actually performance deteriorated rather than maintaining. So their quartile ranking in the last 1 year has been quite lower as compared to other small cap funds. But that's not a problem that the fund has. The problem is primarily the style of management of the fund. The style of management of the fund, Vineet Samre is an extremely good stock picker. He likes to chase momentum going along, and in any such fund, when inflows stop and you stop chasing momentum, and if there is a correction like which has happened in the last 6-9 months in the small caps, the fund is bound to suffer. If you're a long-term investor, this should not worry you, and especially if they are planning to open the inflows. However, if this short-term underperformance is worrying you, you should go to a more conservative fund like a HDFC small cap fund. Again, it is in the same bracket of risk. Don't get me wrong. The amount of risk, when I say conservative, between those two funds, it is slightly conservative. However, if you're willing to ride the momentum along with Vineet Samre, who's, as I again point to you, is an extremely good stock picker, and when the momentum rises, back in the small caps, and if you're believing that, then he will be one of the star performers there.
All right, and he sounded quite confident actually today as well, at least on this small mid-cap space. All right, on that note, what we'll do is take a break, come back in a bit, focus on a lot more queries that are coming in, so do stay tuned to see. Hi, welcome back. You're with the MF Corner. We have Manoj Nagpal here with us to answer the queries that are coming in. And our next caller on the line is Ankur Shrangi, who's calling in from Rajasthan. Hi, Ankur. How can we help you?
Hey, hi, everyone. This is Ankur here. So I have a current portfolio, and I'm currently investing around 16,000 rupees as an SIP.
Okay.
I am 31 years old, and my SIP is in Aditya Birla Sun Life Frontline Equity, HDFC Mid Cap Opportunity, Motilal Oswal Most 35, and Reliance Small Cap, and LNT Emerging Fund. So my query is I'm an aggressive investor. So if my portfolio is good, secondly, I like to increase the amount gradually from 16 to 20,000. So where should I put my money? In which mutual fund I should put my money? And the last one is, I'm also planning to start a new SIP so that down the line I'm going to have, after 3 years when I'm planning to own a house, I can use that SIP for the prepayment of my home loan.
Okay. So you have two time horizons in mind. One is 3 years, which is for the down payment of a home, and one is 10 to 15 years. Is there any goal linked to the longer time horizon?
It is for the wealth creation, for 15 years. It may extend to 20 years also, but it is usually for the wealth creation. And the first one it is not a timeline. I'm just starting a SIP so that after 3 years when I will take a home loan, once it will proceed further, I can use that SIP amount to prepay the home loan.
Okay. No, Ankur, I take your point entirely. One thing at least is very good is that he knows his risk profile. He's an aggressive investor. And I think the selection of funds also seems to indicate the same thing. He has two time horizons in mind. One is, of course, near term. It may not necessarily be 3, maybe 5 or 6, whatever. The next remains wealth creation. Now, that is a very ambiguous goal for anyone to have. Therefore, what would the advice to him be, given his current lot of funds and also the increased amount that he wants to now put in?
Yeah, so he has 5 funds, carefully selected good funds that he has put in his portfolio. So that's a very good starting point that he has. It's split across, various investment styles. So that is another good positive point. We look at the portfolio that's there. And as he himself says, he's a high risk taker. Almost 70% of the portfolio tilt is toward mid cap, and such a portfolio construct would have done extremely well, in the past 5 to 7 years if he has invested. He has been investing at that point of time also. If he has recently constructed his portfolio, then in the short term it's a little high risk portfolio, even for a high risk taker, because the valuations at this point of time in the mid caps are extremely high. Small caps trade at almost 60 to 70 times PE, mid caps trade at around 40 times PE, and the Nifty is trading at around 28 times PE. So you need to understand these are elevated levels of valuations we are seeing earnings is growing but not at the same pace. Macros are getting a little bit edgy at this point of time. So this is a good construct, for the long term. We need to understand that this will be a highly volatile portfolio going forward. I would like to tell him that there are two things that he's asking. Is the first thing is that when the amount of excess money that he wants to put in and increase it to the additional 4,000 in SIPs, I would say 3,000 he should ideally put it in the Birla Frontline Equity and 1,000 in the Motilal Multicap 35. So that is the incremental money he should put in the existing 5 funds. He should choose these 2 funds. What will happen because of that is that he will reduce the volatility of the portfolio without compromising too much on the potential of return. So we always believe ultimately when you're creating a portfolio, you need to balance the risk and the returns. And even if you're a longer term investor, this is one question that we always get from a lot of people. Look, all my money is long term. Can I be 100% in equities? Well, that's never the case, always. Just because your money is long term, you're going to stay invested for 20-25 years, but can you digest that volatility along? Will you be able to hold your nerve when you're going through these cycles is the main question, and most of the people flounder there, not in terms of their long-term horizon. The second question of saying that he wants to put in some money so he can make prepayment of his housing loans, well, I would say that if you have some kitty, you should use that as a down payment of a housing loan rather than trying to create a kitty for prepayment of a housing loan. That's a simple maths a lot of people try to take, that I will take a housing loan at 9 to 10%, my mutual fund or equity portfolio will generate 15%, so I'll gain an extra 5%. You need to remember that this extra 5% does not come linearly.
No, I think he mentioned that it's a down payment.
No, he said prepayment. He wants to prepay his loan. It's not a down payment he's trying to do. So that's where I say that this simple maths does not work in a linear fashion, and ideally if you are taking a housing loan and you have some excess money, increase your EMI. Don't try to do this mix and match of putting some money in a mutual fund so it will generate 15%. It may or may not generate 15% also. You need to remember, at least in the short term, if you're trying to prepay your housing loan. So you should keep that in mind and use the money for down payment and not for prepayment.
All right, Ankur, I hope that answers your query. Finally, a question comes in from Mr. Ashok Bhandari, and he's on the line with us from Mumbai. Hi, Mr. Bhandari. Good afternoon, sir. How can we help you?
Yeah, good afternoon. I have 2 investments, which is approximately about 10% of my portfolio.
Okay.
In about 30 lakhs, in 15 lakhs each in ABSL Dynamic Bond Fund and ICICI All Seasons Fund. Both of them are, I believe, are dynamic bond funds, and the returns in last 2 to 3 years have been rather disappointing. I'm at least looking forward to about 8% of returns. I thought that these were pretty safe, but I now am wondering what to do.
Manoj?
Yeah, so debt funds are always a difficult thing to play on. But if you look at these 2 funds, the ICICI All Seasons Bond Fund was earlier not a dynamic bond fund. It has just become a dynamic bond fund in the recent rejig. And the Birla Dynamic Bond Fund consistently has been in the dynamic bond fund category. So first, we need to understand what do these dynamic bond funds try to achieve. A dynamic bond fund tries to move across the interest rate cycle or the yield curve, depending on what the view of the fund manager is, how the interest rates are going to move. Now, you need to remember that even though they are professionals, they are looking at the interest rates, and talking to RBI on an almost daily basis. Sometimes they will get it right, sometimes they will get it wrong. So these funds, the ICICI long-term, bond, the All Seasons Bond Fund has given actually a return between 9 to 11% in the last 5 years. So if you're looking at a 3-year horizon, it will be 9%. If you're looking at a 5-year horizon, it will be around 11%. That's not a bad return to have. However, the Birla Dynamic Bond Fund has been more volatile, and the returns are in the range of 6 to 8%. And now that ICICI has also become a dynamic bond fund, we think that, again, it will try to, do this movement across the year, which may not be suitable to your profile, since your, goal is very clear that you're looking at 8% kind of a return. The best investment option in the debt fund category at this point of time, specifically given how the macros are, what the RBI views are on interest rates, and inflation starting to inch up a bit, And we are going into an election year where, usually populism sets in, money supply increases. Right. That leads to a slightly higher inflation. That point of time, fixed maturity plans currently offer between 8 to 8.5%. Pre-tax, post-tax, it will work out to around between 7.25 to 7.5 if you are in the highest tax bracket. So I would advise that, shift your money to a fixed maturity plan. There is a 3-year lock-in in that. There is no liquidity. That is the only thing that you need to keep in your mind. But your goal of reaching the returns will definitely be met in these things. All right,
Manoj, thanks very much for your advice. A quick break. Up next, it's Back to Stocks.